All right, everyone, we are starting out with our first lecture today. Before we get started, though, I do want to clarify something that I did not do a very good job of talking about on Monday. So as you all know, your first idea assignment is due on Friday, along with your first homework assignment. And I know some people have already started working on that, and I've received some questions. So I wanted to clarify a couple of things with respect to the first idea assignment. First of all, this first idea assignment is extremely easy, all right? It should be the easiest. The more difficult ones start with chapters 3, 4, and 5, and then they ramp up intensity until you get to chapter 8 and 9, and then they go back down. So if you just want to free 5 points in the class, it shouldn't take too much effort. But I wanted to talk about some things that you should know for the first assignment. So your problem file is where you're going to be referring to this. So the chapter 1 idea problems, basically it's going to say review the first tutorial sections. It's pretty easy reading. It's only a few pages, and it just kind of gives you some introduction as to file management with an idea, which is very intuitive. Your first assignment actually is just going into idea, opening a file, and then trying to tell me how many records are in that file. So this is the important point I wanted to bring up, is that anytime you do work in idea, this is really important because this is something I will expect for every assignment. Anytime you do a piece of work in idea that you derive information from, you need to validate that information by providing me with a screen capture from idea. And this is in the syllabus, so just to clarify that that's the case. So what does that mean? Well, pretend this is idea. I don't want to go through the rigmarole of opening idea, but pretend this is an idea. Basically, this is what you would want to provide to me in the Word document, okay? So does everybody know how to take a screen capture? There's multiple ways to do it. You can hit print screen. You can use the snipping tool. I personally like the snipping tool, so I can show it out. But you would take a screen capture of this, and you would show me that there's 314 records in this file, along with 314 records being down here. You would copy this screen into Microsoft Word, and that would be your submission for problem number 1, okay? Not particularly difficult. It does get time consuming, especially for the chapter 8 and 9 assignment where you're going to be doing this like a dozen times. But it's really important to show proof of your work. Otherwise, basically, I could ask this one question, one person do the assignment, and then 18 other people could basically copy the answer to that assignment, which is why I insist on the screen captures. So yeah, that's basically problem 1. Problem 2, I do want to take a note. This is a little bit less relevant. You will have to work through the tutorial section 3, but again, that's not particularly difficult. But you'll know that problem 1 in chapter 2, it says go to ideacaseware.com and read some success stories. I was looking at these, and it looks like the success stories all are with other caseware products. Makes it difficult to actually learn about idea when you can't actually read anything about idea. So what I would recommend for this assignment, instead of going to idea.caseware.com, instead, just do something simple, like go to Google and say, how can Caseware Idea support external audits? And then just review what the AI tells you and just summarize that in your answer. I know it's a little bit cheap, but I didn't want to get too much confusion on that particular question since it's supposed to be an easy question. Okay. So that's basically how I would encourage you to approach those 2 problems. Like I said, this idea assignment should be really easy. Somebody want to get through? Okay. With that being said, let's kick off our discussion of auditing. So I'm going to kick this off by asking you a question about this course. What is your goal in this course? And I want you to be honest on this. What is your goal in this course? There's you're going to be saying, Dr. Barnes, my goal in this course is to become a great auditor. I want to learn everything about auditing. I want to say, liar. Liar. Your goal is to get an A in this course, okay? Your goal is to get a good grade in this course. Now, let's change the question. What is my goal for you in this course? To give me A's, Dr. Barnes. Yeah. That's it. That's right there. Yeah. Every class dismissed. No, my goal is to make you all into intelligent auditors, to understand and learn the material that you need to know. Okay. So can we agree that those are pretty reasonable? Let's change the prospect a little bit. Okay. Let's change this. After graduation, what is your goal? Is it to get a job? You're going to say it's to get a job, but let's be honest. If I said you could earn $1 billion without doing any work, would you take that opportunity? So what's really your goal after graduation? Earn money. Earn money. You want money, okay? All right. So you're probably going to do that by getting a job. So what is your potential employer's goal? To find qualified people who can do the work that they need placements for. All right. So keep that in mind because that's going to be very relevant. We're going to kind of frame that. So I want to start talking about the origins of auditing with this idea of something called the principal-agent relationship. Has anybody heard about that in a finance class or someplace before? So the principal-agent relationship is how we frame modern-day corporation form, okay? And basically what that means is there are two primary parties in corporate form. There's going to be the owners of the organization, which we term as the principals, and there's going to be the managers of the organization, which we say are the agents. Now, these two parties can sometimes overlap, but by and large, these two parties are separate from one another. When we talk about principals, we're talking about absentee owners, people who basically invest in the organization but don't have any say in day-to-day operations. Whereas the managers on a daily basis operate the organization for the principals. Okay. Now, quick question. Who do you think has more knowledge about the day-to-day information of the organization, where the organization is at a certain point in time? Is it going to be the managers or the owners? The managers, because they're the ones on the trenches. They're the ones doing the work. Okay. This is a concept known as information asymmetry. The owners of the organization have less information than the managers of the organization. Now, that's something important to note. We're going to talk about that because you've already learned a little bit about that, whether you realize it or not. Okay. Now, another thing to note is that managers don't necessarily share the same interests as owners of the organization. If you're a manager of the organization, is your focus probably short term or long term? It's going to be short term, okay, because you're very interested in your performance in this year and maybe keeping your job for the next 5 to 10 years. All right. Sometimes you get a CEO that will be in a position for a long period of time, but usually it's a short term focus. Whereas owners have a long-term focus. They want to generate wealth and then maintain that wealth over a long period of time. That is a conflict of interest that exists, okay? There's a misalignment of interest between these two parties. Now, we've already talked about misalignment of interest. What did we say your interest was in this course? To get a good grade. What do we say my interest was? My interest is to make sure that you know auditing. Are there ways that I can align those goals together? Yes. I can give you a good grade if you demonstrate that you know auditing in this course, okay? So there are alignment mechanisms available. To that same end, we can develop alignment mechanisms with respect to corporate form. Now, a few ways that we've already know about this is we know about financial reporting. Remember those financial statements that you learned how to develop in your financial accounting classes? That's basically an answer to this information asymmetry conflict of interest problem, is trying to align interest and try to mitigate information asymmetry. But something that we came to a conclusion about several decades ago is that managers, this is going to be a shocking revelation to many of you, managers may lie, okay? They may lie about the true position of the organization, okay? Has anybody ever heard of the company Enron? I know that's like it's 25 years old and we still use that as the gold standard for fraud and auditing, okay? But that's a good example of managers not revealing the correct position of the organization. So, and owners are in a little bit of a problematic scenario because they do not know if the manager is lying about the true position of the organization. So what is the solution to that? We bring in people who can actually tell you if the true position stated by the managers is accurate. Those parties are called auditors, okay? More specifically, when I refer to auditors in this context, I'm referring to external auditors, external parties that come in and validate the financial statements of the organization. So, how do we align incentives in between the people in this classroom? So remember, we're talking about your incentive. Okay, you want to get a good grade in this class. My incentive to make you learn auditing. How do we align incentives? I give you a test on your knowledge. Okay, I give you exams. I basically say, here's an exam. If you do well in this exam, you'll do well in this class. How about in the real world when you go get a job? How do employers verify their alignment? Like they're going to give you money, but only if you can do the job. How do they verify that you can do the job?
A bunch of training, but also they're like, hey, if you continue doing well, we'll give you promotions.
Mm-hmm. Yeah. There's a lot of mechanisms. Like at a base value, what would you provide to a potential employer to show that you're qualified for the job? Resume. Yeah, you can give a resume. Okay. This is kind of my resume. It's actually called a vita because I'm an academic. But yeah, the curriculum vitae. Yeah. But auditors do something very similar. Auditors do something similar. They test the client and they issue something called a report, which expresses an opinion of the position of the organization. Now we're going to get a little bit into that. By the way, don't worry too much about the form of this report. This is a really old form report. We'll talk about the new forms of the report later on in the course. So this is the alignment of that, or the alignment, or basically the alignment, the mitigation of information asymmetry, the relationships I was talking about before. We've got our principals over here, the agents over here, and auditors act as a mediator between these two parties. Everything that we're going to talk about in this course is talking about how do we serve in our role as mediators. And that's going to relate to the financial statements, which you're already familiar with, okay? balance sheet, income statement of cash flows, all of those accounts in those areas. And also something that you probably remember from AIS, internal controls. Okay. How do we actually make sure the controls are operating properly? Remember COSA from 367 said, man, I'm glad I'm getting rid of that. Too bad. It's coming back again with a vengeance. Okay. We're going to be talking about controls again. So yeah, this is something that auditors are responsible for. So we need to understand what their responsibilities are. But we're going to get into a lot more depth on that. But let's go ahead and let's keep it at a very basic level for the time being. So let's do some more hypotheticals. In the examination example, what assertions are you making regarding this course? Okay. All right. So when you take that exam, you're trying to make the assertion that you are knowledgeable about auditing. At least I hope that's the case. When exam comes around and you say, Dr. Barnes, I have no idea what I'm doing, I'm going to say that is not a good thing to say. All right. Hopefully you have confidence when that first exam comes around. Okay. So you're saying, I know stuff about auditing. I am knowledgeable about auditing. How am I testing those assertions? With a test. Okay. I'm testing those assertions with an exam. In the resume example, what assertions are you making regarding your qualifications for the job? You're saying, I am capable of performing the tasks you set before me, so you should pay me a lot of money. Is that a reasonable assertion for the job? Would anybody want to take it? I mean, it may be tempting to take a job that you're not qualified for if you got a whole lot of pay, but would that be a long-term solution for anyone? They said you'd go in and you basically say, oh, okay, this is computer coding job in a programming language that I've never seen before. I'll take it. $1 million per year. How long do you think you'd last at that job? Some of you are very, very sharp, so you may actually last a lot longer than you think. But I would say if you took a job on that you were not qualified for, then you probably would not last. Okay. So in the situation that we're going to be talking about, the assertions that you're making is that you're qualified for the job, and they're going to test those assertions through reviewing of your documentation and evaluation of your work on a consistent basis. Okay. So there's two parts that's being waged here, okay? Two pieces of information. There's this idea of assertions that you're making with respect to your qualifications. And then there's the concept of how do we test those assertions? And that's basically the fundamental backbone of auditing, this idea of assertions. So you don't need to write all these down right now. I'm going to give you a list of assertions and I'm going to talk about them very basically. If you furiously write them down while I'm talking about them, that's fine. But we're going to talk about them more in chapter 5. So these are called management assertions, and these are commonly referred to as audit assertions. In fact, anytime you hear the word assertion in this class, 99% of the time I'm going to be referring to one of these 8 items, okay? So what are they? Completeness, existence, occurrence, valuation, allocation, accuracy, rights and obligations, presentation and disclosure, and classification, cutoff, and authorization. Now, you may notice that I've got some initials after these last few. The reason for that is there are 2 standard setting bodies in the United States with respect to auditing. One of these is called the Public Company Accounting Oversight Board, the PCAOB. They are responsible for public company audits. When we talk about non-public company audits, companies that are not traded on open exchanges, this is the group called the Auditing Standards Board, the ASB. They are a subset of an organization you've probably heard of before, the AICPA, the American Institute of Certified Public Accountants. They are very similar sets of standards, but they are separate sets of standards. So just as a reflection, this group right here, PCAOB, they're for public company audits. ASB are for private company audits. Now you may say, what is MGP? MGP are actually the initials of the book authors. The reason why is this last assertion right here is not a real assertion, but the book keeps saying it is, okay? So I included it on the slides just because you're going to see it in the book, but it's not really an assertion. So if you're taking notes on this, write down, Dr. Barnes says this is not really an assertion, okay? It's true, and I'm going to stick to it forever. All right. So the reason I mention these is these are all the assertions that we would actually have to deal with in this course, but some of them are only relevant to the PCOB, some of them are only relevant to the ASB. We're going to talk about all of them in this course. We're also even going to talk about this concept of authorization, though it's not really an assertion. So what does an assertion represent? What does an assertion entail? Let's think about a line item in the financial statements that you probably are already pretty familiar with. This concept of inventory. Has anybody seen inventory as a line item on financial statements before? Hopefully, okay. So if a company puts in a line item of inventory, they say inventory $1 million. What are they representing in that situation?
They have $1 million worth of inventory.
Yes, exactly. They have $1 million of inventory, okay? If we want to get more specific, we could say that management is asserting, okay, there's that word asserting, that this inventory exists and it is properly valued, okay? Which you should note that those are 2 words that are part of the assertions I just mentioned. They're making the assertion that this inventory exists and properly valued. There's actually a lot more assertions associated with it, but these are the easy ones to grab onto. Can we say that if you see a company with $1 million of inventory, you should probably assume that that inventory exists? Okay. Should we say that it is properly valued? Yes, we would assume that naturally as accountants. As auditors, we're going to test those assertions. Okay. We're going to test. What would be an easy way to check and make sure inventory exists?
Count or inventory audit.
Yeah, good inventory count. Go look at the inventory and see, oh, yeah, there's inventory right there. What's an easy way to look at the valuation? Look at what their method of inventory assignment is. Is it FIFO, LIFO? And does it make sense to us with the cost that they paid for the inventory? There's a lot of ways that we can actually test that, okay? But the idea being is that management is making an assertion regarding these accounts. We have to test these accounts. So the first part here, the assertions, is basically the assertions that management represents. Every single account we're going to talk about has implicit assertions associated with it. And then you may say, how do we know which assertions that we're going to be talking about? I said, patience, young Padawan, we'll get there, okay? But anybody get the Star Wars reference? Yeah, okay, great. All right, so let's talk about now a little bit quick about the testing of assertions. So first of all, I do want to make a note. When we talk about these assertions can fall into one of two general categories, okay? The first category is transactions and events. The second category is account balances. Now, you don't need to worry too much about what's in this slide, but I do want to make a note, the reason for this delineation, okay? When we talk about transactions and events, these basically refer to day-to-day transactional balances, okay? So you might think about an inventory purchase, a single-time inventory purchase. That would be an example of a transaction or an event. We talk about account balances. These are items in the financial statements, aggregations of transactions and aggregations of information within the financial statements themselves. So inventory has a balance of $1 million. There's a difference between a single transaction and an aggregation of those transactions, but we're concerned about both concepts as auditors. Now, you will notice that there's assertions listed according to each of these, and a lot of times these assertions overlap. Even though we have the same assertions for different categories, these assertions mean different things depending on what we're talking about. We're talking about an assertion related to transactions and events. We're talking about usually individual transactions that occur on a daily basis. We're talking about assertions related to account balances. We're talking about how does all this aggregate together to form the information in the financial statements. Probably one of the most important things to consider is, what do these represent? Okay, what do these represent with respect to the financial statements? Now, I want you to make a note, this is not going to make a lot of sense right now, but it will make a lot of sense when we get to the point. I want you to write down, when we talk about day-to-day operations or transactions and events, these can apply to controls and something called substantive procedures. Substantive procedures. I can't talk today. Substantive procedures. Now, you may say, what are those, Dr. Martins? And I'm going to tell you right now, it's not going to make any sense if I tell you right now, but when we reflect back on this here in a few chapters, you'll say, oh, that makes so much sense now, okay? So controls and substantive procedures. When we talk about, yes?
Right. Controls and substantive procedures are a part of what?
A part of transactions and events.
Investment.
When we talk about account balances, these are going to be financial statement items, and these refer to just substantive procedures only. Now, why do I make such a big deal of this? This is going to come up multiple times in this course, okay? Which one did I say controls was relevant to? Transactions and events only, okay? It's not relevant to account balances. That means anything that we test an account balance, we're not going to, or anytime we're looking at account balances, we're not looking at controls, okay? Now, again, this seems like a small issue right now, but this will be a big deal later on, and it will alleviate a lot of confusion if we get that out of the way. When we talk about transactions and events, that's the only place that we can categorize controls, or more specifically, how we test those controls. Now, from financial statements perspective, you probably already know how a financial statement works. Management's going to implement internal controls. They conduct transactions for the organization, and they accumulate those into financial statements. We issue these financial statements to the users, and that's the external financial reporting process. As auditors, we need to line up our procedures to understand how this is going to work and how we're going to gather evidence and test these. So the auditor is going to work with management to work out the terms of engagement, which will be one of the first things that we learn. I think it'll be what we'll talk about on Friday, terms of the engagement. Then we're going to gain evidence about the controls, the transactions, and the account balances. We're going to test management's assertions against criteria. For most of our situations in this course, that's going to be something called GAAP, which I think you're probably familiar with, generally accepted accounting principles. Now, make a note here. GAAP is a financial reporting criteria. It's something that you should already be familiar with. That is the criteria of financial reporting. So it's going to be what the client refers. There are rules for the client. Auditors also have a separate set of rules, so we're not going to go into a lot of depth on, but how they conduct their audits. That's called Generally Accepted Auditing Standards, GAAS, GAS. Our focus is primarily going to be on GAAP because that's what we're testing, but we're going to talk very briefly at certain points in the semester about what are the rules that we have to follow as auditors, and that's going to be following those rules of Generally Accepted Auditing Standards. Then we determine that the financial statements are presented fairly, and we issue an audit report to accompany the financial statements, which we're going to get to the audit report here in just a second. But let's go ahead and talk about 3 fundamental concepts related to financial statement audits, okay? The conceptual procedure details of financial statement audit build on 3 fundamental concepts. The first of these, which we're going to talk about in the second part of chapter 3, is materiality, okay? Materiality. Now, you can write these down, but I'm going to go in more depth on all these concepts here in just a second, all right? Second of these is something called audit risk, audit risk. And I want to make a side note here while we're at this point right here. These 2 concepts, materiality and audit risk, these combine to affect the nature, extent, and timing of audit evidence to be gathered. So depending on the level of materiality and audit risk that we identify in an audit, or more appropriately, the factors of audit risk, the components of audit risk, which that will become more sensible when we get to chapter 4. Those affect how much evidence we have to gather, or the nature of evidence we have to gather. Now, that doesn't make a lot of sense right now, so let's go ahead and let's make sure that we understand how, we use a silly analogy to understand this, okay? So let's assume that I make the assessment. I'm going to stand in front of you and say, I'm an accountant. How many of you think you would have a difficult time proving that statement? Should be a pretty easy statement to prove. Like you go online and says, he teaches accounting, he's got a CPA, he's got a PhD in accounting. Yeah, he's probably an accountant, okay? Very minimal evidence that you would need to gather to prove that particular assertion. Can we make that assessment? Yeah. Let me change that, okay? I'm going to make the assertion to you, I'm a superhero. All right, do you think that would be a more difficult task to prove? Yeah, because in true superhero fashion, if I am a superhero, I'm not telling anybody about it. I keep my identity hidden, okay? So you're going to have to follow me on those long nights patrolling the streets of Kirksville to make sure that crime is being kept under control, which, yeah, depending on where you're at, I do a good job or do a horrible job. It really depends. I do a crap job. Yeah. So, it might be more difficult to say that. If you were trying to prove that, you would need to gather a lot more evidence, all right? So the more extreme a situation is, the more evidence we have to collect. That's basically what's being said here. The third concept is the idea of audit evidence. And audit evidence is how we test management assertions, which I'm going to get to here in just a second. Let's talk a little bit about this concept of materiality, all right? So by the way, before you know, I actually did get Dr. Caden's approval to use this next image on these slides. This is something I did a long time ago. So your favorite band, the Caden Brothers, which is not to be confused with the Jonas Brothers, is playing 2 dates in Kirksville. You've made the decision to skip auditing class because apparently they only play at 1:30 in the afternoon, which is weird. I guess they don't want to stay up too late past their bedtime. But you're going to attend one of their performances. You have 2 possible choices. Missing a day that will be working on an A-class assignment, which is 5 points, or missing a day will be taking an exam, which is 100 points. Which do you think is the better option for you? Probably the first option, 5 points. Say, okay. Because you know that this class is worth 500 something points, and 1% of your grade is probably something you can rebound from. Whereas 100 points, that's like 2 letter grades right there. Okay. So certainly that. Now, is that contingent on what the basis of the class is? Like what the baseline points value in the class? Like if I change it and say there's 1 million points in the class, does that change your answer? Yeah, at that point, you're just kind of like, I don't care. 1 million points, I can miss either one. I can miss both. I'm just going to go to both concerts and enjoy myself twice as much. All right. So we do need to make sure that we understand what the base value is. This is the idea of materiality. So basically, we're trying to actually make a determination of what will affect the decision makers of users, the decisions of people who use this information. So the FASB, Financial Accounting Standard Board, they have a definition. Information is material if omitting it or misstating it could influence the decisions that users make on the basis of financial statement of specific reporting entity. So one of our tasks is to determine whether or not amounts are material to financial statements. Now, here's a question. Is $1 million a material amount? Very good. That's where I was going to angle for. You got there before I did. Yes, always answer a data accounting question. It depends. What does it depend on? It depends on the size of the organization. We're talking about Greek corner euros down the street. Is $1 million material? Yeah, very material. Okay. If we're talking about Walmart or the Walmart Corporation, is $1 million material? Not at all. Okay. So it really depends. It's contextual, the situation, and that's what we have to analyze and make a determination. All right. Let's get into audit risk. Okay. So one thing that we're going to talk about at length in this course is this concept of reasonable assurance. In fact, the auditor standard report that we're going to look at in chapter 18 states the audit provides reasonable assurance that the financial statements do not contain material misstatements. All right. So before we move on to the discussion here, why are we using the term reasonable assurance? Wouldn't it be better for auditors to provide absolute assurance? So why don't auditors provide absolute assurance?
Human error.
Well, human error is part of it. Yeah.
Sometimes they are in on the fraud or etc.
Well, you're reaching beyond what you're correct, but you're reaching beyond what the basic crux of the question is. You are absolutely right. Okay, but we don't like to think that auditors would actually be corrupt like that, but sometimes it happens. But let's at a more basic level. If I say I want you to be absolutely sure that you can get 100 points on this, or 100% on the first exam, 100 points would be impossible on the first exam. It's only 60 points, but 100% of the first exam, would that stress you out? How much work would you have to do to get absolute assurance that you were going to get 100% on the first exam? Like literally infinite, okay? You would not have time for anything else. So absolute assurance is one of those things that just basically is practically impossible, okay? That's why we use this concept of reasonable assurance, because we are human beings with time and resources constraints. So we're going to provide enough assurance, but not guarantees. So the phrase reasonable assurance applies that even when an auditor does a good job, there is some risk a material misstatement could be present in the financial statements, and auditor will fail to detect it. So if you are reasonably certain you're going to get an A on the upcoming exam, does that mean that you won't miss any questions? There's a possibility you could miss some questions, even if you feel really confident about the first exam, because your studying may not cover every single little detail I may ask. So that's the idea of reasonable assurance. You do a good job in studying, but you still may miss a question, right? Same idea will hold an audit. Audit risk is the idea the auditor mistakenly expresses a clean audit opinion, basically saying everything is fine when the financial statements are materially misstated. That is a big no-no. How many people have taken a science course here at Truman State? Do you remember type 1 and type 2 error in scientific method? So type 1 error basically says that somebody says that there is a problem when in fact there's no problem. As auditors, we generally don't care about that, okay? When we say that there's a problem, there's no problem. Our clients are going to get upset about it, but we're generally less concerned about the second. We're more concerned about type 2 error. Type 2 error says that there is, when we say there's no problem, and in fact there is, okay? So yeah, that's one of those problems that in scientific testing is really, really problematic when you basically say everything is fine, and in fact there's an issue, okay? That is one thing they frown on, and the same thing for auditors. If we say everything is good, we need to be reasonably certain that everything is good. Even then, there's a possibility that we can make a mistake, okay? It's a possibility we can make an error. All right. Last thing we're going to talk about is audit evidence. And I want to talk really quickly. We're not going to go into a lot of detail. Don't write these all down because we're going to go into a lot more depth in this. We have a lot of different ways to collect evidence. So if I were to say, how would you test assertions? You might say, Dr. Barnes, I would collect accounting records because that's something you're fairly comfortable with, okay? And I want to tell you that that is a good answer. That's actually this idea of inspection of records of documents. Those are looking at accounting records, those for testing. But you will notice that this is one of about 8 items. Technically, it's 1 of 10 items because there's 2 actual subsets of this that we're going to get into. There's all kinds of different types of testing that we can do to verify assertions. And only one of these specifically relates to looking at accounting records, okay? Some of these are pretty apparent. Like if we talk about inspection of tangible assets, if I say that I own a car, can you actually validate that that car exists? Yeah, you can go out in the parking lot and say, oh, there's Dr. Barnes' car. Yeah, okay, that's a possibility. Observation and inquiry, those are pretty apparent as to what those mean. Some of these are a little bit more opaque. Like what does a confirmation mean? What is a confirmation? What does that entail? The answer is, we'll get to that here shortly. We'll get to that idea of a confirmation here in chapter 5. These are all methods of gaining assurance, this concept of guarantee information or basically confidence about what our assessment is of the organization's situation status at a point in time. So once we perform all this testing, the idea is that we're going to conclude our testing and we're going to reach an opinion about what the financial statement situation is. Now, optimally, we would like to do something called a clean opinion. That means the financial statements are free from material misstatements. When we talk about a clean opinion, that's something that we call an unqualified opinion. Okay, an unqualified opinion. There's no qualifications to be made. You also might want to make a note of this because this will come up in the readings. The term unqualified is something that's used for the PCAOB and the PCAOB only. The Auditing Standards Board, the ASB, uses the term unmodified. So unqualified and unmodified mean exactly the same thing, but they're used by two different parties. The good news is our other report types have exactly the same name, but this is the only one that has different terminology. So unqualified is for PCAOB, unmodified is for the ASB, and they mean that everything is good. Everything is good. The financial statements are free from material misstatements. Now, what happens if there is a problem? Okay, what happens if there's a material problem and we can't get the client to fix it? We've got a couple of different options. There are actually like 3 different options. So let's talk about the ones that are least severe. All right. The first possibility is a qualified opinion. Okay. A qualified opinion. A qualified opinion says that basically there is a material misstatement, but it's not a massive misstatement. It's not a pervasive misstatement. Pervasive is the term that auditors use. So it's material, but not pervasive. The way that we characterize qualified opinions is 2 words. Except for the effects of the issues listed below, 2 words, except for, the financial statements are present fairly in all material respects the financial position of the company. So the financial statements are free from material misstatement, except for this issue. So whenever you see a qualified opinion, you're looking for 2 words. Those 2 words are except for. Now, what are the situations that a qualified opinion can arise? The first of these is pretty straightforward. This is called a departure from GAAP. And when I say GAAP, I'm talking about generally accepted accounting principles. You can make an accounting joke here about the GAAP, about the advance of the GAAP. Anyway, yeah. So terrible. Anyway, so departure from GAAP. The client did not follow the rules of accounting or financial reporting. Because they're required to follow generally accepted accounting principles. They did not. That's the first possibility. The second possibility is something called a scope limitation. A scope limitation. We're going to hear that term used a lot throughout this course. What is a scope limitation? So scope represents the work that the auditor performs. Okay, when I say what is the scope of my work, you're going to be able to say, well, you tested all these parts of the financial statements and you gathered evidence to support that. That is the scope of my work. So by nature, what would the term scope limitation imply? The answer is that somehow my work was limited. It was restricted in some manner. Now, say that you needed to do 100% of your work to have confidence that your work was fully complete, and you only got to do 80% of it. Would you have confidence that your work's fully complete if you needed to do 100, but you only got to do 80? That's the idea of a scope limitation. Our scope was restricted, so we can't actually come up with a good answer to the problem. If it's a minor restriction, we consider that to be a qualified opinion. Now, the 2 extreme opinions, these are where we talk about pervasive misstatements. The first of these is called an adverse opinion. And this is basically saying there is a material misstatement. The financial statements are not free from material misstatements. So there's a problem, and it's a massive problem, okay? It's a pervasive misstatement. A pervasive misstatement. Basically, this only comes up in one scenario when there is a pervasive departure from generally accepted accounting principles, a pervasive departure from GAAP. The other extreme opinion is something called a disclaimer of opinion, which is actually not really an opinion at all. This is where we as auditors say, we can't issue an opinion. Why might we come into that situation? Well, the first scenario, the most common one, is there's a pervasive scope limitation. A pervasive scope limitation. Our scope was so restricted that we could not do the nature of our job that we needed to be able to do it, to issue an opinion. Therefore, we do not issue an opinion. This is going to be the case in about 95 to 98% of the times that we issue a disclaimer opinion. We're going to be talking about that pretty much exclusively in this course. But there is one other possible minor scenario, which we'll talk about a lot later. That is if the auditor is not independent from the client. If there is a lack of independence by the auditor. This will not exist in all of our audits because we're going to be talking about public company audits, but this can exist in private company audits. So if the auditor is not independent from the client, they cannot issue an opinion. All right. So where we're going from here, we're going to start chapter 3 next week, or sorry, next Friday, and we're going to continue it on next week. We're going to be talking about planning the audit the week after, and then we're going to get into testing. Then we're going to take a break and take an exam. Then we're going to go to internal controls. We're going to jump ahead to chapter 17 to conclude the audit and talk about reports in chapter 18. We're also going to talk about some audit-related concepts, assurance and attestation, which I'm going to talk about here in a moment. And then we're going to wrap up with chapters 10 and 16. Now, you may say, why did I put them out of order? The answer is it's the order that I got the diagram in. So we're actually not following the sequence. I used to, but I jumped a little bit out of sequence for future years. So this is going to be the end of what we're going to be doing, the business process areas. With respect to auditing, auditing is just basically a part of two larger concepts, attestation and assurance. Now, I'm not going to go into a lot of depth about this because we're going to cover this when we go over chapter 21 before the second exam. But basically, when you hear the term assurance, you should equate that to gathering confidence, okay? Gathering confidence about a situation. Auditing is a form of assurance service. In fact, if you actually get an auditing internship, they probably tell you you're going to work with assurance services, not the working in the auditing practice, because assurance is a much broader concept. Attestation kind of falls in the middle. By definition, attestation is a form of assurance, and auditing is a form of both of those. So don't worry too much about those, other than the idea of these ovals represent auditing as a very specific type of testing or type of engagement. Attestation is more broad, and assurance is very broad. It encompasses all these concepts. And so we're going to talk a little bit more about what other types of things we can do that don't necessarily fall within the purview of auditing. But I want to get to my favorite discussions, okay? So philosophical thoughts. Is it possible to do well in an exam without knowing the material covered on the exam? What do you guys think? Yeah, it's possible. Yeah, possible. Are there reasons why the most competent and qualified candidates for a job might not get hired? That's also a possibility, okay? So on the exam, you could cheat. Okay, don't do that. On the resume, you can lie about your qualifications. But if you get the job, is it justified? Do the ends justify the means? He's like, this is a trap, isn't it, Dr. Barnes? Yeah. All right, so I want to talk a little bit about my scenario, okay? So what is my favorite food? Yeah, hopefully you remember that. It's like, I don't remember anything BIS, but I remember cheeseburgers, Dr. Barnes, okay? I actually got a t-shirt for the Mac holiday party where somebody gave me a cheeseburger t-shirt. It was great. I'll have to wear it one day. But anyway, so let's say I'm going to Seabreeze, which is my favorite place to get a cheeseburger, and I'm sitting down about to get my cheeseburger from the kitchen, and they're preparing it, and I see the door open, and they're preparing my cheeseburger, and I'm really excited, and then I see the cook sneeze on my cheeseburger. That's never happened, by the way, okay? I know this is a visceral example that may want you to... That's never happened at Seabreeze. I'm just using this as a visceral example, okay? Just a visual example of what I'm talking about. So does it matter if my cheeseburger is delicious anymore? Am I going to want to eat it? I mean, knowing me, yeah, probably. But would anybody else in their right mind want to eat it? Probably not. So can we say the ends justify the means? No, okay? It doesn't matter if the cheeseburger is delicious. I do have other concerns. I do want to make sure that the cheeseburger is prepared properly. How is this even relevant to auditing? Okay, the answer has something to do with this thing called the Sarbanes-Oxley Act. Prior to 2002, audits focused exclusively on whether financial statements were free from material misstatements. Testing of internal controls is optional and frequently an afterthought. So they didn't care if the controls worked or not. They just basically said, we want the end result to be correct. After the Sarbanes-Oxley Act was passed, basically, they instituted auditor testing of internal controls. So now we want to know not just what the results are, but how the client achieved those results. There is a focus on process as well as result. So the idea being is not only do we want to know that the cheeseburger is delicious, but we want to know how it was prepared and that it's sneeze-free. I'm a big advocate for sneeze-free cheeseburgers. Otherwise, they're sneeze burgers. Let's be honest. Those are less delicious. At least I assume so. Okay. In this course, we're going to be talking about this concept of financial statement audit. But the financial statement auditing will often be paired with something called a controls audit. And that is basically testing internal controls jointly with the financial statements to ensure that the method that the financial statements were derived is also reasonable. So not just the end result, but also the process to achieve those results. So we're going to have a focus not just on the financial statement accounts, but also the controls that were used to generate those accounts. Okay. So a few last notes. This is the chapter 2 stuff. Okay. So what are some types of auditors we're going to talk about? Our primary focus in this course is going to be external auditors. We're also going to talk briefly about internal auditors and government auditors. And my favorite one is forensic auditors, which we're not going to go into a lot of depth about forensic auditors. But if you are joining the MAC program, we do have a forensics course that I get to teach because who says 2 thumbs in the forensics auditor is this guy. Yeah. I used to be in forensics and I work with audit support. So yeah, I'm really, really gung-ho about that. So other audit services are internal control audits, which we are going to get into because these are part of the PCAOB audit testing. And they do have a few different requirements than financial statement audits, which makes sense because financial statement audits focus on the financial statements, okay? Internal control audits focus on internal controls. So what is the distinction between that? It's a pretty big distinction, but it's not really more important that we get into right now. We're going to get into a lot more of detail about what those represent and how we actually separate the testing for those out. Trust me when I say it sounds daunting, it's not really. It's a little bit of a delineation in testing procedures. We're also going to talk very briefly about compliance audits when we get a little bit later in the course. Compliance audits are just basically making sure that our client is following laws and regulation in their industry. Operational audits, this will be something to test and make sure that the operations that are set for the organization are being followed. This would be something that Dr. Otero would be excellent at because we're talking about the management philosophy and management operating style within the organization. And then forensic audits, this is mostly if fraud has occurred. There's also other types of attestation and assurance services and some non-audit services, though for the most part, these are now prohibited by the SEC. Okay. Why? Because in the past 15 years, this is actually closer to like 20 years now. I need to update my slides. Can't you tell when I wrote these slides originally? Yeah. So in 2002, the auditing profession was self-regulated, which basically means that the auditors basically checked their own work. Okay. So imagine that. Imagine that we do the exams and I say, okay, now the exams are done. Hand that to your neighbor and they're going to grade exams. And so you hand swap exams with another neighbor and you're basically like, hey, if you give me a good grade, I'll give you a good grade. Would that happen? No, Dr. Barnes, we'd never do that. I imagine if I had self-grading within the class or grading with the peers in the class, my grade average on the exams would be much, much higher. Not because you would have bad intentions. It'd be like, oh, they meant to write down C on that one. They circled B, but they meant C. That's perfectly fine. Yeah, just fine. Okay. Self-regulation was a problem. How do we know it was a problem? Because we had a whole bunch of this, a whole bunch of this, and a whole bunch of this, and this, and this. Okay. So a lot of things going on. As a result, we got this. Okay. The Sarbanes-Oxley Act of 2002. Sarbanes-Oxley Act of 2002, we're going to talk about a few components of that. But for the most part, the biggest thing we need to know about the Sarbanes-Oxley Act of 2002 is it created something called the PCAOB, the Public Company Accounting Oversight Board. I've already mentioned that in this particular lecture. The PCAOB is responsible for setting the standards for all public company audits in the United States. Now, these standards are a little bit different from private company audits, but these are going to be the focus of our particular course here. First of all, because they're a little bit more simple and straightforward. But secondly, if you do go out to auditing the real world, you are going to probably be subject more to public company audits than private issuer and non-issuer audits. That being said, we're going to talk about all of these jointly, but I do think it's important to start at the highest level so we can look at the largest clients and talk about what they're subject to. All right. Last things to talk about. Over the course of the semester, we're going to talk about this idea of due professional care and this concept of professional skepticism. So due professional care requires that you exhibit professional skepticism, an attitude that includes a questioning mind and a critical assessment of audit evidence. So if I say, are you professionally skeptical? What would you say? You'd probably say, I don't take anything at face value. I don't accept anything assessment. Now, I know that goes against what you say or what you're expected to do. If I say something in this class and say, this is the way it is, then you're probably saying, well, he's the expert, he knows best. But sometimes you've got to question what's being said, especially in an audit. If you're given a piece of information, you need to prove that that piece of information is valid. Sometimes you have to corroborate information, which means gathering other supporting information for that. Skepticism is basically the foundation of auditing, saying that we do not just accept what we're given. We try to make sure that it makes sense in the context of what we're looking at. So in addition to regulatory auditors, auditors are generally accountable to a governing body of organization, corporate governance. Have you heard that term before, corporate governance? So when you heard the term corporate governance, you probably have heard the term board of directors, which is basically representatives of the shareholders organization. We're also going to be talking about a group called the audit committee. Okay. Now I'm not going to talk a little too much about them right now because we're going to talk about them in more detail on Friday about what the audit committee is. But these are the corporate governance groups that auditors are ultimately accountable for, assuming that an audit committee exists. As far as business processes, this is going to be the end of our semester. We start talking about these. Auditing is going to be specific to business process areas. So what we're going to do is we're going to be learning about general auditing techniques. We're going to reinforce those in the second exam, and then we're going to be very specific at how we apply those auditing techniques in given scenarios. We're going to start with the revenue process, move on to the purchasing process, and then talk about some ancillary business processes after that. All right, last thing to talk about. One thing that's really, really critical in auditing nowadays is this idea of ethics, okay? Which is a system or code of conduct based on how moral duties or obligations indicate how we should behave. More important to that is this idea of professionalism, which is how we display our ethics. We've actually got something in auditing and under the CPA guidelines called the Code of Professional Conduct. We're actually going to have a lecture specifically about the Code of Professional Conduct. But the Code of Professional Conduct is the rules by which auditors and accountants operate by when they're providing assurance services. One of the biggest and most important areas with respect to the Code of Professional Conduct is respect to auditors' independence, or the CPA's independence. Independence is this idea that we have no material interest in the client that we're operating with. And if we do, then we kind of either recuse ourselves of those interests or recuse ourselves of the client, one of the two. The Code of Professional Conduct is pretty much the gold standard by which we operate by. We can't violate that under any conditions, any situations. That was a lot to take in, wasn't it? Did you get all the notes down? All right, that's done. We're done here. We'll start chapter 3 on Friday.